This is the Clear Money Talk podcast, offering up creative solutions for your retirement future through education, choice, transparency, and empathy. Now, your host, CEO and founder of Clear Financial Partners, Tim Claremont.
Hello, and welcome. My name is Tim Claremont. I am your host of the Clear Money Talk podcast and the CEO and founder of Clear Financial Partners. Happy to be here, as always, with co-host Tyler Andrews.
Co-host Tyler Andrews. Thank you, Tim.
Yeah.
I'm excited.
Do you want some adjectives?
No.
I feel like I keep introducing you with adjectives in the past. I didn't give you the adjective illustrious, magnificent, amazing.
There it is. It's
phenomenal.
been a few weeks.
So yeah,
just keep hyping me up. I like
fill in
this.
your head with all those adjectives right there. There you go. The wondrous Tyler Andrews.
I like it. Tim and I are each other's hype men. So whenever we need one of us to get hyped up, to be motivated for something, we just call upon the other to get us amped up.
That's right.
Yeah. So we're in the podcast studio, which I always like to start off and mention, and we're getting juiced up about talking about money stuff.
Yeah,
for all
I'm
of you
excited.
listeners.
Hopefully you're excited too. That's the idea.
I hope so.
So what's our question for today?
Question of the day: how can you give the gift of investments and build wealth for loved ones?
How can you give the gift of investments and build wealth for loved ones?
Yes.
So as you think about that, we're nearing the end of the year, and you might be thinking about various holiday gifts and things of that sort. But at the same time, and maybe you're not yet, it might be a little early for you yet. That's okay too. I'm not, I'm not unfamiliar. I know it's a double negative, but I'm not unfamiliar with procrastination when it comes to gift giving. However,
Sure.
Whether we hit it with you early or late or wherever you're at on your gift-giving mentality, there are some significant tax ramifications that can come into play when you keep too much of your money in your own name. And a lot of people with wealth start to decide, how do I transition this money in the most tax-efficient way possible from myself to those who I love? This is especially easier if you've reached a point in your life where you've determined that you're probably not going to spend it all before you die. And there's a phrase that I use regularly with clients, and we use it all the time, which is every asset you have is a live on or leave on asset. Either you will spend it during your lifetime or you will leave it on for someone else to spend. And if you've determined that you're likely to have a significant amount of leave on assets, the tax treatment associated with them is probably worth giving some consideration. So how do you give the gift of investments to loved ones is really is really a big question, big topic for a lot of our clients that will bounce off ideas, and we can end up going down a lot of tax rabbit holes in this process. So
Yes.
Before we jump into those rabbit holes together, which I anticipate we will do, at least a few of those holes today.
Naturally, it'll happen.
That's going to happen.
Yeah.
I want to give you the disclosure. We are not accountants. We are not attorneys. We are not out to give you legal advice, and we are not out to give you tax advice. Your specific tax situation needs to be reviewed with your own tax professional. So please keep that in mind. And when it comes to taxes, just to give you a little bit of an insight, there are 3 ways to look at helping you plan your taxes, and this is probably worth sharing just to get set a baseline framework for this discussion. There's a difference between tax planning, tax management, and tax preparation. And the easiest way for me to communicate this is using the analogy of building a house. When you have an architect that designs a house for you, they create a blueprint. That blueprint is a plan. That's similar to a tax plan. Now, you can hire somebody like us or another financial advisor or tax professional to pay them to create a blueprint for you. And that's your tax plan in terms of what you want to do. Now, when it comes to building the house, somebody's going to actually, you're hiring that general contractor to build the house. They're going to put in all of the flooring and the foundation and all the other stuff you have to do correctly. There's some things that are hard to anticipate that the blueprint doesn't necessarily see. Maybe something funky happens with the land when they're pouring the foundation, or a pipe bursts, or some kind of equipment issues happen. When you're building the house, that's tax management. Now, when we manage portfolios for our clients, a lot of times we do things to try to manage the tax consequences, and that's an ongoing job as far as tax management is concerned. Things like what we talked about, I think on our last podcast, we talked a little bit about tax deduction creation, also known as tax loss harvesting, as another strategy that we can address in tax management. Again, something that we work with our clients and typically in conjunction with their accountants to accomplish. But the third element, tax preparation, that's like the home building inspector that comes out at the end and says, okay, your house has been built. We see where it is. Let's go ahead and fill out these forms correctly, and let's make sure that we've dotted the I's, crossed the T's, and met all the compliance regulations. That tax preparation is what we do not do. That's what your accountant does for you. They're going to defend you in an audit. They're going to help you fill out those tax return forms. But in general, we work in conjunction with your other tax professionals to make sure that all three aspects of the tax management process, both tax preparation, tax planning, and tax management, are taken into consideration. And many times we find a lot of clients have just been having that home building inspector. They've created their own blueprint or failed to create a blueprint. They've built their own house and they've just got different contractors in there, slamming stuff into the ground and throwing the walls together. And then they have the inspector come out and take a look at it and say, yep, all right, this looks like it's not going to fall over. Or maybe this looks like it might fall over. Let's tweak this here and there. Let's hoist some things up. And if you're doing your own blueprint creation for tax planning and you're doing your own tax management, let's just hope that you have the right skill set to do both of those jobs. And if you aren't doing that or you're not having a professional do that, you might want to consider working with somebody like us to help you in that process. But I just wanted to give you the background of that. As we talk about some of these ideas, these are some of the tax planning strategies and tax management strategies that we've used with clients over the years as we think about answering this question. So how do we gift that money to minimize taxes? And I'm as Tyler was talking earlier today, for those of you who get to know me at a personal level, you'll know that occasionally I'm over caffeinated. And I would say that in this particular moment, I am a little bit over caffeinated. So if I'm talking a little faster than normal, or I'm getting a little bit more excited about that, catch me.
Tim loves taxes.
Catch me.
That's why he's
exactly
excited.
true, yeah.
And the whole point, you're probably like, why is Tim and Tyler talking about taxes? I thought we were talking about gifting investments to people. Taxes is a huge consideration for gifting of anything, whether it's gifting. It could be literally gifting anything, and taxes comes into play, whether you're gifting your 16-year-old a new car. And if that's your situation, you're very fortunate, so that's awesome. Whether it's gifting cash, whether it's gifting a house that you bequeath to somebody when you pass away, whether it's gifting investments that you've accumulated during your lifetime and you are in a situation where you don't feel like you're going to need those assets and you would like to gift them to somebody else. All of that comes back to the foundation of taxes and minimizing taxes. Unless you want to pay more taxes, you can legally do that. No one's going to stop you. I mean, I hope some people would try to stop you, but your CPA or otherwise. But taxes is the foundation for all this stuff, and that's why Tim's starting the podcast off with talking about that. As we now get into talking about gifting investments and how to do that and why it might make sense for you and all that.
Yeah,
so.
No, I appreciate that, Tyler. Yeah. It's good to bring it back. Because I can go down that tax rabbit hole pretty well and just have a really good time chasing the white rabbit. So
absolutely,
let's step out of the out of the rabbit hole and go back to our question. So let's say that you're interested in giving some stuff away, right? You've determined it's not for you. You want to give it to some loved ones, and you want to try to give them something. And you might have heard in the past that you can gift up to $14,000 or $15,000 or $16,000 a year without generating some kind of massive consequence. And that's the amount of money that you can gift to an individual without having to report it on a tax gift return. It's not the maximum amount you can give away without a tax consequence. So if you've got, let's say, $20 million, for example, sitting in your bank account, you could gift more than that $15,000 number. By the way, that's in the past, it used to be 14. I think it might be up to 18,000.
I believe
now.
It's 18 in 2024.
Yeah,
double check your sources though.
Yeah. It's changed a little bit over the years. There's a little bit more room now, so I think it's 18,000 now that you can gift. But that's on a per person basis. So let's say you have 3 kids, and let's say that 2 of the kids are married. So there's actually 5 individuals there. You could gift 18,000 to each of your 3 kids. Plus, you could gift $18,000 to those spouses of your 3 kids. So you could essentially get rid of, if you're trying to shrink your estate to try to minimize estate tax consequences. That's one of the reasons that people will do this kind of gifting. But let's say that you wanted to just give away things. You could gift up to $18,000 in that case with those 5 individuals. That's almost $100,000 that you're giving away and getting out of your estate in 1 year, with none of them having to pay any taxes on it, you not having to pay any taxes on it, and you not even having to file a tax return for it because it's under that $18,000 level. Now, what if you're married, you and your spouse? You can gift that $18,000 to each of those 5 people, and your spouse can gift $18,000 to each of those 5 people. So now you have $200,000 you can gift away. So there's a lot of room to do some gifting of what's called after-tax or post-tax money pretty easily. The challenge comes when you try to gift pre-tax money, like an IRA account or a 401k account. That does not work. You can't just gift that while you're alive, or you have to take a distribution for it and then pay income taxes on it. And that's going to have significant tax ramifications. So you're going to have to pay taxes, and then you can only gift away the after-tax money after you've taken it out of those pre-tax accounts. And on the other hand, there might be some assets that you don't want to gift away because maybe they're more tax efficient if you hang on to them and pass those on. There's something called a cost basis step-up that's worth considering. So which assets to give is actually a pretty key question that you want to make sure you answer correctly, and it's unique for every individual. How much you can give is what we were just talking about with that $18,000 limit, but again, that's not the max. You have a lifetime exclusion of how much you can gift, and right now that exclusion is extremely high. The Tax Cuts and Jobs Act increased the exclusion significantly, and even though the Tax Cuts and Jobs Act is set to sunset at the end of 2025 at this point, so in 2026, you're likely to have a much smaller amount of money you can gift. For now, this year and next year, you can gift as much as, I think it's $12 million or something.
It's right around there.
Yeah, it's right around $12 million
right around
per
$12 million.
person. So you can gift that tax-free. That means you don't pay taxes on it to gift it. Your kids or your heirs or whomever you gift it to doesn't have to pay taxes on it to receive it, as long as it's been after-tax money that you've already paid income taxes on, or capital gains taxes for that matter. But the point is, if it's tax-free after-tax money that you have, you can gift away a much, much larger amount. You just have to report it on your gift tax return to use up some of your lifetime exclusion that you're allowed to give, and that's at a federal level. Now, states are different. You got to double check that. Some states have mapped to the federal level, and that you can gift the same amount of money, and it has the same impact in your state. Other states have no tax consequences on the money that you give away. That's great too. And yet other states, like Oregon and Washington, have much lower estate tax thresholds, whereas federally you can gift over $12 million right now when you die, as far as to your heirs, without any estate tax consequences. In the state of Oregon, anything over $1 million, your kids are going to be dealing with estate taxes in the state of Oregon. And it starts out at about 10%, gets 10 to 15%, give or take in that range. So imagine if you have $5 million of an estate, you pass away in, Oregon, for example, and let's say you're married, your kids might be able to exclude taxes on the first $2 million, but that additional $3 million that goes over the threshold, you're going to get hit with about 10 to 15% taxes. That's $300,000 to $450,000 that gets donated to the Oregon Department of Revenue because you died in this state. Alternatively, had you been in a different state, the kids may have gotten the same $5 million without that $300,000 to $450,000 tax bill. That's the significance of doing some good planning and dying, frankly, in the right state from a tax standpoint. Mm-hmm. There's 3 entities that are going to receive your money when you pass. It's your heirs, it's charities, if you want to give it to charity, and it's Uncle Sam. We just try to help you make sure that the maximum amount of money goes to the places you want it to go. And as Tyler said earlier, you can always give more money to Uncle Sam if you want to. They will take money, literally. You can donate to them. There's nothing that stops you from doing that, and they're happy to take the money.
They are.
So back to gifting. If you're just going to gift some small things under $18,000 a year, no big deal. It's pretty easy to do that. Just go ahead and gift it. If you're going to gift over $18,000, just make sure you fill out that tax return that says, hey, I'm going to use up some of my lifetime gift exclusion, and just fill out the return. Know that you're not going to have to pay taxes, but you do want to fill out the return so that you don't get in trouble for not filling out the return. Mm-hmm. And if you're trying to figure out which assets to give away, or if you have a desire to either build wealth by giving some assets, there's a lot of cool strategies we've had with clients over the years where you might want to gift them in ways that express your values. Now, you might give them, no handcuff money, which is like, no, here, take 15 grand, let's see what you do with it, or take 18 grand, let's see what you do with it. And you just want to see what your kids or your grandkids might do with it, or maybe it's going to add value for them in their lives, and you don't really care, and you just want to let them do their thing. That's okay. Nothing wrong with doing it that way. But we have some other parents or grandparents that are trying to encourage their kids to do some stuff that they think the kids should be doing, that the kids or grandkids are maybe not doing. So maybe consider something like a matching strategy for retirement savings. If your grandkid or your kid saves 10 grand into retirement accounts, then maybe you'll match them with $10,000. And if another kid only does 2 grand into a retirement account, you only give them $2,000. That's still fair. It's not equal. One kid got 10,000, one kid got 2,000, but it is fair as long as you communicate in advance the strategies. And we've seen clients do this sort of thing over the years. It's a great way to pass on your values It doesn't have to be saving. It could be other things. Maybe you're. I'll share another idea, but I got to take a breather here and let Tyler make some comments. So I'll talk about another idea of how you might be able to gift money to encourage values, something that I'm doing personally.
Tim, I'll give the listeners enough meat here to let you take a breath, but I don't really have many comments. I mean, I feel like you're doing a phenomenal job of explaining all the ins and outs of this and things to consider. All this is things to consider. I mean, it shouldn't be taken as recommendations or anything like that. It's just things that, based on our understanding of law, tax law, strategies, all that we've dealt with on a personal basis with our business clients or only our personal investments too, that we wanted to share with the public. So that's the whole point of the podcast. Really, is just to share what we know and make it more known to everybody else out there.
Yeah, it's too true. But, my personal BHAG, my big, hairy, audacious goal is to teach 1 billion people something smart about money. This is the beginnings of teaching 1 billion people something smart about money. If you learned something smart about money today from this podcast and you have not yet gone to somethingsmartaboutmoney.com, please go to somethingsmartaboutmoney.com and get counted. And we want to climb that counter. We just broke 100 recently, so we're early stages. We'd love to see that get to 1,000. Love to see that get to 10,000, and so on as we
snowball effect
work our way towards the billion. But educating the masses about this smart money stuff. This does not need to be the secrets of the rich. Okay, this is the stuff we want to share with everyone, so that everyone can take advantage of these things. There's some money wisdom out there that if you just do the smart stuff, it can be transformative in terms of your life experience because of what you choose to do today and how it'll affect your financial future. And that's the nature of a lot of the insights that we try to share with you. One thing, I guess, from a values standpoint that I was going to share. So my own estate plan is set up such that I'm going to have a significant amount of wealth left behind if I were to pass away. And that's actually going to be going into a couple of trusts. And one of the trusts is designed to reimburse education expenses for my kids and my grandkids. So if they have education expenses, it'll reimburse, I think, up to 100% of their bachelor's degree education and maybe 50% of their master's degree education. So it's nice to have that bucket of money for education. That's a common value to take care of. The second thing to consider is we also have a family bonding trust that I've created. And the family bonding trust concept is I used to take each one of my kids on a one-on-one trip every year for a week. So I have 5 children now. Unfortunately, Marshall joined the fray later on, and it was after we'd stopped with this, but I would love to reinstitute it again. I'd be happy to spend the time. The kids get busy with their lives now, so they're not as interested in that. But when they were kids, 1 week a year, 4 weeks out of the year, I would be traveling and spending time one-on-one with that kid. I wanted to make sure that my grandkids and my great-grandkids had the same opportunity. So creating a trust, it'll reimburse up to 75% of the expenses for one of my kids or my grandkids to take their kid on a one-on-one trip for anywhere between 3 and 14 days. And that's the kind of stuff you can do if you want to pass on more than money. If you want to pass on values, you can go ahead and pass on values. And that's, you can do that by creating things like trusts where it's just a pool of assets left intact beyond your lifetime. But if you want to gift away some stuff right now, just start thinking about that. Are you paying for a kid's college? Are you paying for a grandkid's college? What if you have some highly appreciated stock? Like, what if you bought Amazon or Apple or one of these other stocks a long time ago, and you paid maybe theoretically $50,000 for it, and maybe it's worth $500,000 today? You have $450,000 of unrealized capital gains in that stock. And if you sell it today, you're going to pay long-term capital gains taxes on it, assuming you've held it for over 12 months, and depending on the state you're in, possibly state income taxes as well. Now, your tax bracket might not be particularly favorable. You might end up with a 20% long-term capital gains tax bracket because of your income. What if you were to gift that money to the kid, let the kid sell the stock, and then they pay taxes in their own tax bracket? It's at least worth looking at. In many situations, we've seen gifts like that be a way to minimize the tax impact on the asset, and you can actually divest yourself of some of the assets you've been interested in diversifying instead of just giving cash. So think about some of these other strategies. Make sure you're working with a professional that integrates that into your plan.
Absolutely.
Yeah.
I think that's great.
Other thoughts?
I think there's a lot of thoughts. I mean, you just talked about downward gifting to a younger generation. There's certain things to be on the lookout for that. If you're a grandparent gifting to a grandchild, there's certain things. There's the generation skipping transfer tax to just be aware of and try to avoid that if you can. That could potentially negatively impact that strategy if that's something you're doing. There's upward gifting, which is instead of gifting to a younger generation, gifting to an older generation. And there's certain reasons that one might want to do that to, if you have a highly appreciated asset like Tim was just talking about, a way to gift to them, and then when you receive the gift back eventually, I think the rule is you have to wait 1 year from the date that you gifted it to then receive it back. You should hypothetically in that situation get a cost basis step up, which should then put you in a position to be able to sell that asset if you wanted to with no tax implications. So there's all these different strategies and things to give consideration to. That's all any of this is. Give consideration to if it falls into your realm of what you have going on in your finances and it makes sense for you. Give consideration to it.
Yeah, I can't iterate enough, Tyler. I appreciate you bringing that up.
Yeah.
This is a moving target. None of the information we're communicating to you should be assumed as true for all eternity. This is only true today, like literally today as we're recording this. Yeah. Tax law changes. That's the one constant. Taxes and, two constants, taxes and death, right? We all know about death and taxes. Those are the two constants. But tax law is constantly changing. And so when you have an ongoing relationship with a professional that's helping you manage your tax consequences, building that house for you, then that's the person who's going to adjust and work together with the other professionals to get the most accurate information at the time that fits your situation to help you minimize legally your taxes wherever you can and optimize the amount of money that's going to go to your family, whether it's during your lifetime or upon your passing.
Absolutely.
Yeah. I think that's probably a good place to
I
stop.
think that's great.
We probably need to hit just the answer, though.
Yeah, just the answer. So, let's hit the topic again.
Okay.
How can you give the gift of investments and build wealth for loved ones?
Got it. How can you give the gift of investments and build wealth for loved ones? So you can't gift away your pre-tax money. That's the quick in the just the answer. Without paying income taxes on it. So that's usually not one of the assets you want to give away. You might be able to move some of your tax-advantaged assets that might generate tax-free income into something like an irrevocable life insurance trust or an irrevocable trust to minimize your estate taxes. So give us some consideration there. But it's your post-tax money. It's the money that you might have highly appreciated stock or real estate or vehicles or cash or things like that you might want to consider gifting. And keep in mind the gift limitations associated with the annual gift allowance of $18,000 per person. But it's okay to gift more up to your lifetime. Just use up some of your lifetime exclusion, and you can give away, over $10 million right now, at least under current tax law in 2024, and expected to, likely be that way in 2025. Expected to change for the worse in 2026, assuming that Congress does nothing. Literally,
and that's a federal level, right?
Yeah, at the federal level, that's right. Yeah, and then in the states, make sure you double check with your states.
Yep.
I think that's probably a good minimal just the answer, but there's a lot of additional meat here. If you listen to the just the answer, you should seriously consider listening to the whole
Go
thing.
listen to the full podcast.
Yeah. It's fun anyway.
Yeah, it's a good time.
Yeah, you're going to miss out on trivia if you don't listen to the full podcast.
That's right. Are you ready for some trivia?
Let's move into trivia.
Okay.
Let's move into trivia.
Okay, I got a riddle for Tim this week. Yeah, trivia is fun, but I'm getting trivia'd out. There's only so many trivia questions that exist. And he's pretty good at trivia. Give him a multiple choice question, he's usually going to remove 2 immediately and be left with a 50-50 chance getting it right. So we got to give him a riddle today.
All right.
All right. You ready?
Elimination is powerful, but yes.
That's right.
Okay, go ahead. Yeah, what do you got?
Rich people need it. Poor people have it. If you eat it, you die. What is it?
Rich people need it.
Mm-hmm.
Poor people have it.
And if you eat it, you die. What is it?
I don't know. Let's see. Oh, man. If you eat it, you die. I don't know. Free time comes to mind, but that just still doesn't really fit. Usually when you say the right answer, it fits the riddle. I can't continue to, as much as I would enjoy pondering this for longer than the time we have on this podcast, out of sake of you listening to me think, I'm going to have to say, you got me. I don't have the answer quickly.
That's fine. It's fun to hear the answer.
What do you got?
Are you ready for the answer?
Yeah.
Okay. Nothing. Rich people need nothing. Poor people have nothing. If you eat nothing, you're going to die.
All right.
So,
good. All right. Good. Yeah. Good riddle.
Yeah.
Well said. Well
I
said.
didn't come up with it. But
well,
yeah.
that's, when you author your own, you can tell me about
That's
it.
true.
So that's
Yeah.
good. Thank you for sharing, Tyler. I hope
You're
the
welcome.
riddle confounded you as it confounded me, or if you already knew the answer, good on you. Very cool. If there are answers to money-related questions you don't know the answer to, give us a call.
Oh,
That's what we're here for.
that's
So,
right.
yeah, give us a call.
Should I plug our
503
number?
Yeah, go for it.
Okay, 503-579-1000.
There you go.
That's it.
503-579-1000. Give us a call, and we'll book a 15-minute get-acquainted conversation with you and see if it makes sense for us to consider a potential of a relationship. But at a minimum, no obligation, no cost, 15 minutes, just chat it up and see how we might be able to help you. Thanks for listening today, and until next time.
Investment advisory services are offered through Clear FP Advisors, LLC, or Registered Investment Advisor. Securities are offered through Clear FP Securities, LLC, member of FINRA IPC. Exposure to ideas and financial vehicles discussed should not be considered investment advice or a recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments may fluctuate and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Timothy Claremont is licensed in your state, please contact his office. Clear FP Advisors, Clear FP Securities, and Clear FP Life LLC are not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide tax and/or legal advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Clear FP, LLC NPN number 194283777 and or Clear FP Securities NPN number 197499604. Any discussion of general investing strategies or specific securities are for conversational purposes only and should not be taken as a guaranteed endorsement or recommendation.